2025 has been a tough year for retailers, as the promise of structural reforms and investment in the broader economy post the formation of the GNU has been sluggish. In assessing the near-term outlook, it's important to reflect on the past year that has been influenced by a few factors in terms of headwinds. Firstly, moderating inflation, which weighs on retailer top line, while supportive for volumes, is not a one-for-one offset. Secondly, waning consumer confidence, which reflects a bifurcation towards the lower and the upper LSM segments, as middle-income consumers are as downbeat now as they were pre-GNU. Thirdly, muted credit growth. Fourth, online gambling, and arguably a thematic of consumers adjusting their category wallet allocation. In terms of tailwinds, firstly, some support in the form of rate relief, albeit somewhat shallow, real wage growth, lower fuel prices, and food inflation kept in check. Secondly, incremental two-pot flow for the first 3 quarters of the calendar year, all of which we find has provided support to more interest-sensitive product categories. For example, car sales, where we think two-pot flow is provided in funding a deposit, and lower interest rates aided in improving affordability metrics. No doubt, there is an inherent catch-up post-COVID of car sales. We're also noting better growth in the home and beauty categories, the former likely linked to better home sales and renovations, while the latter linked to providing the little luxury purchase with high utility, a global thematic. So how should one think about the near-term outlook? Unfortunately, the ingredients for a robust festive season are elusive. Firstly, inflation is expected to remain subdued, somewhat good for the consumer, not so much for the retailer. Secondly, catalysts to lift consumer sentiment appears few and far between, with much of it hinging on a November SARB rate cut. Thirdly, two-pot flows over the latter part of 2025 are not going to be as elevated as they were in the 2024 fourth quarter, impacting the propensity to spend. We therefore expect the base to prove too high a hurdle as consumer wallets remain tight and credit extension controlled. Therefore, while SA Inc. appears attractive, we expect near-term earnings amongst most of the discretionary retailers to disappoint, particularly considering the elevated festive season base effects. That said, while confidence in the growth outlook remains depressed, expectations have real GDP growth lifting into 2026 to about 1.3%. Should this materialize, we expect market participants to grow increasingly optimistic on ratings and the earnings outlook into the second half of next year. Till then, it's likely to be a bumpy ride.